John, thanks for your time. It's Westpac's AGM this week, your third as chairman of the bank. Last year you had a fairly blunt message for shareholders around the bank's performance. What do you plan to tell them this year?
I think I'm looking more forward than backwards now. I mean, I tend to live 2 or 3 years out rather than in this year or the previous year. I mean, my reflection on where we are is it's been hard yards getting to this point, but we've created a very strong foundation now for future performance in the company, and therefore I think the best is yet to come. And so I'm very optimistic about this year and beyond. So I think those investments and that hard work have been worth it.
And the bank has been very focused on simplifying, streamlining and reducing cost in particular, but at the same time investing in technology and building digital capabilities for customers. Do you think the bank is striking the right balance there?
Well, remember, your agenda depends on your starting position and the environment that you're facing. In normal circumstances, we would naturally evolve into a digital position, increasing investment, because people today are using mobile phones rather than cash or going into branches. And therefore, in order to keep pace with that, and remember the fintech players are very, very fast, very agile. And therefore that's a competition that we really need to match. And so it's a very important investment that we do this. However, we are always going to be a premium provider. There will be room for face-to-face banking going forward. And so it can't all be digital. It's actually got to be a good balance, and therefore investing in both is necessary. The issue for us has been our starting point was weaker than it should have been, because we lost over a number of years market position and performance. And so we had to enter what was a normal turnaround, which is turning around the market position of the company, but also turning around the economics of the company so that our efficiency levels were brought back to competitive levels, which we're getting there. I mean, we had a big improvement in the last 12 months. And of course, the journey will continue there because we're not quite at the level we want to be. So that's a function of trying to find more revenue growth, but it will also be a function of more efficiency gains.
And the bank is 2.5 years into the turnaround strategy of the Fix, Simplify and Perform agenda, and it is in better shape as a result of that. So the big question is, where's the focus now? What do you see as the big challenges moving into the coming year?
Fortunately, we've been dealing with the past issues very well, and we're putting them mostly behind us. The efficiency levels have gone up considerably, and therefore that's a little bit to go, but it's been very good. And therefore we're performing better. We're not quite performing where we want to go, but we do now have the foundation for that performance, notwithstanding this environment. Slight benefit from rising rates, a disadvantage with a decline in the economy. But nevertheless, that should still be a good period for us, and therefore that's something that shareholders can look forward to.
And finally, just on the economy more broadly, you've already touched on the fact that we are facing into some fairly challenging conditions coming up. So if we could just dig a bit deeper into your view on that economic outlook and how the bank is positioned as we face into those headwinds.
Well, it's perfectly clear that inflation is with us. And fortunately, it's not as high here as it is in other places. And so the medicine that's needed is not as severe as needed in other places. For example, in the United States, you're getting 75 basis points movements in rates. You're getting very large rises in New Zealand, for example. We've been managing in 0.25% rises, which seems to be an appropriate level of increases. However, it looks as if they're actually getting somewhere with it. And the markets are, whereas they were predicting 4% cash rates, the markets are presenting much lower numbers now. You know, the 2-year bond rate is just over 3 now. And so the market's saying this hasn't got a long way to go. And so that's a good thing. And so maybe this medicine slows down. And that will mean that, the constraint on the economy will be lifted to some extent. So we might actually be facing slightly better circumstances earlier than perhaps we might. If you're running a bank, you can't think like that. You've got to plan for the worst and hope for better. And therefore, we've just got to be making sure that we're there if the economy does turn down and that we batten up the hatches. We're not getting a lot of signals of stress at this point in time. That, depending on the circumstance, may not last. And therefore, we should be prepared for losses were that to be eventuating, but we're not seeing it at the moment.